So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time because the very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over a long period of time, but I don't know enough to pick the winners and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
For active investors, patience is essential. Rather than buying average investments in an overvalued market, wait for rare, high-quality opportunities. Following Warren Buffett's philosophy, even a few exceptional stocks over a lifetime can lead you to become rich. Passive investors, on the other hand, should consistently invest regardless of market conditions. Using dollar-cost averaging in a broad market index fund allows them to ride out market fluctuations and achieve average market returns over time. Buffett emphasizes that passive investors should ignore market timing, headlines, and short-term market noise, focusing instead on long-term growth. Historically, even severe downturns, like the 2008 financial crisis, rebounded over time. For both strategies, having patience and a long-term perspective is key. Active investors should wait for quality opportunities, while passive investors should steadily invest without trying to time the market. In 2021, Warren Buffett warned that combining massive fiscal spending with near-zero interest rates would likely lead to inflation. He was right. Inflation has since risen sharply, impacting the economy and posing new challenges for investors. Buffett, however, has long provided guidance on investing during inflationary times. In his 1982 letter to shareholders, he outlined two characteristics of businesses that perform well during inflation. They must be able to raise prices without losing customers, and they should be able to increase revenue with minimal additional capital. Companies with the ability to raise prices while maintaining market share are often those with strong brands and competitive advantages, or moats. For example, Apple and Coca-Cola can charge more for their products without significantly losing customers, helping them offset inflation's impact. The second key to success during inflation is scalability. Businesses that can grow revenue without heavy additional investment are better positioned to handle rising costs. For instance, Facebook can increase ad frequency to boost revenue, while manufacturing companies like Ford would need to invest heavily to scale production. Low interest rates have played a significant role in pushing up stock market valuations. When interest rates are near zero, traditional investments like bonds yield low returns, leading investors to seek higher returns in the stock market, which pushes up stock prices. Buffett compares interest rates to gravity. When rates are low, asset prices rise more easily. As interest rates increase, however, this gravity strengthens, potentially pulling down stock prices, especially for overvalued assets. This shift is something investors should be prepared for. Since early 2022, interest rates have been rising, adding pressure on stock valuations. As rates go up, bonds become more attractive, reducing the flow of money into stocks and making high stock valuations more difficult to sustain. Buffett's approach to investing remains straightforward and enduring, regardless of market conditions. He looks for companies with strong competitive advantages, reasonable valuations, and a margin of safety, emphasizing patience and discipline rather than market timing.
Three wonderful businesses is more than you need in this life to do very well.
In periods of overvaluation, Buffett is content to hold cash instead of buying overpriced stocks. This strategy has led Berkshire Hathaway's cash reserves to grow significantly over recent years, highlighting his commitment to waiting for worthwhile opportunities. For investors navigating inflationary times, Buffett's advice is clear. Focus on companies with pricing power, scalable business models, and strong competitive advantages. Meanwhile, as interest rates rise, understand that valuations may come under pressure, and prepare accordingly by following a disciplined, long-term approach. Warren Buffett believes that not everyone is suited for investing due to the emotional and psychological demands. However, with the right education on stock ownership, many more people could become comfortable with it, understanding that buying stocks means owning a part of a business. Buffett has demonstrated his investing prowess since taking over Berkshire Hathaway in 1965, achieving an impressive 20% annual return on average, far surpassing the S&P 500. His approach centers around a few timeless principles that have led to Berkshire Hathaway's extraordinary long-term success.
We have to deal in things that we're capable of understanding. And then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life. That's a very simple set of ideas. And the reason that our ideas have not spread faster is they're too simple.
Buffett's business partner, Charlie Munger, encapsulates their investing philosophy in 4 key rules. Invest only in businesses you understand. Seek those with a durable competitive advantage. Prioritize capable and honest management, and only buy at a reasonable price to ensure a margin of safety. This simple approach has remained constant regardless of market conditions, illustrating the timelessness of their principles. Whether it's 1984 or 2022, Buffett and Munger adhere to these fundamentals, demonstrating that discipline and simplicity are essential in their investment philosophy. Despite its simplicity, this approach has not gained widespread adoption, possibly because it seems overly straightforward, in an industry often focused on complex strategies. Munger emphasizes that adhering to these straightforward principles is challenging but effective. In the current environment of high valuations, inflation, and rising interest rates, Buffett's advice is more relevant than ever. He cautions against overpaying for stocks, especially in an overvalued market, and stresses the importance of patience and discipline in such times. Finding undervalued stocks in today's market can be challenging, even for seasoned investors. Buffett himself has encountered difficulty identifying attractively priced businesses to acquire, as noted in his 2019 shareholder letter. However, he remains patient rather than investing in overvalued opportunities. Instead of rushing to buy stocks at inflated prices, Buffett has chosen to accumulate cash, waiting for better opportunities. Berkshire Hathaway's cash reserves have grown significantly over recent years, highlighting his willingness to hold off rather than make imprudent investments. This strategy underscores a critical investment lesson. Sometimes the best move is to do nothing and wait for the right opportunity. Buffett's approach stresses that successful investing is not about frequent buying and selling, but about making the right moves at the right time. Overall, Buffett's long-term approach emphasizes understanding business fundamentals, valuing patience, and maintaining discipline, regardless of market trends. His principles serve as a guide for investors navigating challenging market conditions, reminding them to focus on quality and value. If you can commit to this mindset, investing in a downturn becomes much easier. If you found it valuable, hit the like button and subscribe, and I see you in the next one.